Hello, everyone, and thank you for joining us today. My name is Samantha Johnson, and I am the Assistant Director of Alumni Engagement at the University of Colorado Boulder's Leeds School of Business. Leeds is a top business school offering undergraduate, MBA, MS, and PhD programs, and has an alumni network of over 41,000 strong living and working around the world. We're excited to have Roberto Caccia presenting on risk management before, during, and after the financial crisis. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask, please send those questions through your chat interface. I will monitor those questions as they are submitted, and they will be answered throughout the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants later today with a survey link. Now, I'd like to introduce today's speaker, Roberto Caccia. Roberto is part of the faculty in the finance department of the Leeds School of Business. His teaching experience covers risk management, investments and portfolio management, derivatives, and special topics on investment banking. As Burridge Center Director, Roberto promotes the connection between the school and the industry through a number of initiatives involving student body and faculty. Prior to joining the school, Roberto was a managing director in the New York office of Goldman Sachs, where he spent 14 years, 12 years as a strategist focusing on commodity and credit derivatives, and then 2 years as risk manager for the global trading areas of the firm, creating and leading the counterparty risk management team. Roberto also spent 2 years at McKinsey Italy as a business analyst, where he consulted for clients in the energy and banking sector and was a lieutenant in the Italian Air Force while completing his PhD in electrical engineering. Welcome, Roberto, and thank you so much for being here.
Thank you very much, Samantha. I'm flattered by your introduction. And hello, everybody. And it's a pleasure to be here. Virtually, I hope to meet most of you personally over the next few months, and maybe I have met some of you already in the past. Today, we're going to talk a little bit of risk management, and I want to cover a few topics. And the title of the webinar was the risk management before, during, and after the financial crisis. And I would like to share a few thoughts with the audience. I would like to talk about the risk manager mindset. It takes a special mindset to be a risk manager. We'll mention a few comments on the evolution of risk management, and things that happen that shouldn't have, and what we learn from it. Obviously, some stories from the trenches during the crisis, best practices about techniques, procedures, governance, the Goldman Sachs secret sauce, as sometimes people like to joke, and maybe some example of risk management applied to, maybe simple but illustrating examples. And I would like to start by teasing the audience with a picture. Imagine that everybody had their coffee this morning, and I would like to put this picture on the screen. This is a coffee and some music. How relaxing, right? Think about, pretend to be a risk manager and see what you see in this picture. This is a simple one, right? You're a risk manager and this is your child's car, and you find this car like this in the garage. You're a risk manager. What do you think? How about this one? This is subtle. What is this thing? This thing is one of those not so modern hi-fi sets, and towards the bottom, you see the old-fashioned CD player that nobody has anymore, but we used to have it once upon a time. And it's a very interesting configuration. You will probably notice that these images have something in common, and something that makes you feel a little uncomfortable, but let's try a few more. How about this one here? How about this one here? When I show this one to my students, everybody starts laughing. I can't hear that because all of you are on mute, but some of you are probably smiling. Look at those arrows painted on the concrete, on the pavement. How about this one here? This person is probably taking too much risk, but not as much risk as this one here. What a cute child. Or two very cute children watching Thomas the Tank Engine while taking a bath with the TV set dangling on the edge of the tub. Who doesn't want to go on vacation? I mean, look at this thing here. It's fantastic, right? This is actually a real picture. I didn't make this up. This is St. Martin. Look at the shadow of the little airplane about to land feet away from the head of the person sitting on the beach. How about this one? I swear you, I didn't make this up. This is unbelievable. I found these pictures on the web. People actually do these things. Even in architecture, we like to take risk. And all of these pictures have something in common. They make me feel uncomfortable. I wouldn't want to be at the coffee shop at the corner of the street under that ball that is sitting on the edge of that roof. This is a precious one. Somebody fixing a truck and holding the truck at 45 degrees with two 2x4s. They're like touching the pavement just on one little corner. And he even put the rock behind the wheel so that the truck wouldn't roll backwards, because of course the road is on an incline. It's quite amazing. This is a great one. I always like to show this to my students, and I cannot believe that this is real. This is probably people posing and teasing us, because I don't think that anybody would do that. So all of these pictures are just to warm up the audience a little bit to the idea of risk management, but we need to define risk management. What is risk management? As Samantha introduced to the audience my background, she said that I spent time on the Goldman Sachs trading floor. In particular, during the financial crisis, I was the guy in charge of quantifying counterparty risk for Goldman Sachs, and then working with the, at the time, the one risk manager to advise the trading division management, the head of the division, on what's going to happen. That gentleman went by the name of Bruce. Bruce was my Jedi master. I learned everything from him. And he and I were joined by the hip during the financial crisis. And he told me, Roberto, risk. What is risk? Risk is the pain of being wrong. And it was a very interesting definition, and you can apply it to many different situations. Sure, let's try to manage risk, but what kind of risk? There are many kinds of risk. You have market risk. You can lose money because of a change in market prices. Then you have counterparty risk. You can lose money because the counterpart's credit deteriorates, or they fail to perform, or they take actions against you. Let's not forget the third one. That's a very important one. During the financial crisis, Goldman Sachs was concerned about our counterparts failing, and I have some stories from the trenches. But after the financial crisis, when people started seeing that even big companies like the Goldman Sachs and the Morgan Stanleys of the world could actually be at risk, they started working on increasing the degree of protection against the banks, so that when we were signing these big contracts, these master agreements, ISDA agreements or other master agreements to trade, they started adding their lawyer teams, they started adding clauses to protect themselves against the Goldman Sachs. And for them is one protection. You can imagine taking the view from the other point of view. When I was in charge of the overall team of counterparty risk management, having to being the person on the hook for signing approving the eased agreements against all of these counterparts, you can imagine I was a little bit nervous and sitting at the edge of my chair when I was seeing all of these clauses that people wanted to add against us. Liquidity risk is another kind of risk. You can lose money or you can go bankrupt because of inadequate funding. Let's think about what happened to Lehman Brothers, right? They had pretty heavy balance sheet. On the asset side, they had long-term illiquid bonds. And on the liability side of the balance sheet, to fund all of this, there was a very heavy component of short-term debt, such as overnight repos, commercial paper, etc. And when things go out of balance, your funding is inadequate, and you may end up defaulting. Model risk. You develop models as a financial institution. Doesn't have to be necessarily a broker dealer like a Goldman Sachs, but all of us use financial models to make decisions. It could be a trade, it could be a project, it could be an investment strategy or portfolio. Well, if the model is wrong, you will lose money. It potentially could be a lot of money. Operational risk. Once you had gone through all of this stuff and you have your model, you sign your documents, you know that your counterparty is there, you do the trade. What if you fail to follow the right processes or use the right systems, and people actions can be incorrect, and you may end up putting the risk, the firm at risk, at danger. Regulatory risk. You can have sanctions due to a failure to comply with regulatory requirements. You always have to have somebody looking out for that. Which leads to the next step, which is legal and compliance risk. You don't follow the right legal guidelines. You have compliance issues, and the industry and firms like the big banks have many people in the compliance department, scattered throughout the business. Obviously, reputational and headline risk is a good one. There are many examples out here, but I would like to, given that pictures are worth 1,000 words or more sometimes, I want to put this picture on the screen. This is, in particular, I'm going to focus on this jump here and look at the dates. This is mid-April 2010. And the white box at the top is covering the title, because if I give up the title, maybe that will jog your memory. I'll give you a moment to think about what this could have been. And now I can imagine people Googling Yahoo Finance or Google Finance to figure out what happened on that day. Well, this is something that happened to a firm, and something that still carries a scar on my skin. You may have guessed that this is something that happened to Goldman Sachs. It was a glorious Friday afternoon, 2010. During the weekend, I was flying here to Boulder, Colorado, to visit, and I had arranged a guest talk like this one, and the SEC. There was a big headline that came out that the SEC was going after Goldman Sachs and one person in particular for a subprime trade that had happened, known by the name of Abacus. And the market obviously panicked. People sold Goldman Sachs. Look at what happened between 8:35 and 9:20. A drop of price from 180 to 155. A good chunk of people's retirements went off the window because of that. There was a big headline risk. The market reacted negatively. People were really concerned that who knows what sanctions Goldman Sachs is going to go under, and obviously big sell, and people ran like headless chicken for a good chunk of the day. So all of these risks and all of these things have implications, and there are moments in history, given that the human race tries to be prepared, but there is always something new that you didn't anticipate. So there are moments in history that define risk management and how the industry reacted, how we as a collective group of professionals came up with new ideas on how to prevent, mitigate, anticipate risk. And I would like to define, there are three different buckets of events. There are market-wide and systemic events. Stuff happens, impacts everybody. A meteorite lands on planet Earth. With my students, I like to joke and I say, Godzilla steps on planet Earth and havoc happens and it impacts everybody. Exogenous problem, and people couldn't quite anticipate that. Then there are firm-wide, more idiosyncratic events, things that happen to a company. And the slide before with the chart of Goldman Sachs price dropping because the SEC was going after us is an example. And then you have events caused by individuals, by single people. And there are quite a few egregious examples in history, and I'll try to list a few, and I'm sure that there are more. The asset classes that are subject to risk are many. Of course, the equity market is something that we all look at. It happens all the time. First thing I turn the TV on in the morning, on CNBC, I look at what happens to the Dow Jones. But there are other asset classes. There are bonds, commodities, futures and options on the above. You have swaps, including credit default swaps and this infamous three-letter acronym CDOs that were infamous during and after the financial crisis. You have mortgages, including our own, bank accounts, as people learned many years ago when they were run to the banks, and other property, real estate, vehicles, etc. So let's talk about market-wide events. Were you ready on Black Monday, 19 October 1987, happens to be my mother's birthday, but she doesn't know what happened in the markets. The crash began in the east and spread west very quickly. And this is a chart that happened during this very infamous day. Everybody suffered significant losses, and in addition to licking our wounds, the industry decided to have some forms of measure. And in the late 1980s, people, the financial sector introduced the methodology of calculating VAR, value at risk, and also capital calculations. So this is one of those examples that something happens, the market reacts, and you do something about it. I'd like to pause here for a moment to A, catch my breath, and B, see if there are any questions from the audience, ranging from I can't hear you, or you're going too fast, you're going too slow, or anything of the sort.
Thanks, Roberto. And I did send out a chat as well, but reminder to everyone, those questions can be sent through your attendee panel. So if anyone has any questions, we'll give it a few moments here.
Sounds good. And by the way, if you have questions such as, what is VAR and how is the methodology, I have something in the back as an appendix that if we have time at the end, I can show some of the methodology that we use in the financial sector for that. I'm going to forward to the next slide. I have a collection of other market-wide events, and I actually, over the past couple of days, I collected some charts that illustrate these examples. 1994 Mexican peso crisis. That was an interesting time. The peso was pegged to the dollar. There were some problems at some point. And there are different theories on what caused what, but at some point they had to remove the peg, and this is what happens. This is the exchange rate between peso and the dollar. Clearly, you can imagine in the moment of, in the span of days, the market reacted, and there were major losses, which spread to other markets. There is always some element of contagion and panic. I remember, as kind of a little note of color, my boss's boss, the person who hired me at Goldman, that year he was promoted to partner. And at the time, to become a partner, you had to commit your own capital. There was a private partnership. The Goldman Sachs was not a public company yet. And when he saw all of this and the market disruptions and the potential financial implications, he actually had to think about whether he wanted to accept the nomination into partner and actually to commit capital and personal wealth to back the firm. You can imagine how prestigious it may be to be promoted to Goldman Sachs partner, and if this person had to think about it for a few days, you can imagine the amount of pain and discomfort that this risk that you see here in a chart must translate into a person. 1998, Russia default during the summer, which then percolated into other markets. You probably remember LTCM, long-term capital management, that failed, and there was a government bailout. But this is the value of investing $1 in 1994 or $1,000 in 1994 in various things, such as in the orange US Treasury, red in the Dow Jones, and blue in long-term capital management, which had a epic collapse and had to be rescued. The dot-com bubble. This is kind of a slow moving train wreck, but you remember how the market since 1995 had, increased gradually, steadily, not real major things, and then in the spring of 2000, things started going south, and you can see here the quick decline of the market after a number of years of increase in the market. And that had implications not only in the regular equity markets, but also you can imagine in the venture capital world, and the private equity world. Many companies, many investors lost money there. A little fast forward, just a year later, September 11, terrorist attack, and it wasn't pretty. And for those of us who were in New York City, you felt the disruption, you felt what happened, and it was across many markets. You can see a hole there, markets closed. The first airplane hit the North Tower. In the base of the North Tower, you had the New York Board of Trade, you had coffee, cocoa, orange juice, and other soft commodities trading there. If people remember the movie Trading Places with Eddie Murphy, which was a fun movie, well, they were trading OJ in the North Tower of the World Trade Center. Everything stopped, markets disrupted in different directions. Obviously, the equity markets went down. Interestingly enough, when people were screaming for their relatives on the trading floor, I heard phones ring of people, some speculators who wanted to buy crude oil and jet fuel because they figured that there would be some military repercussion. The price of fuel, jet fuel and oil would go up. Obviously, people were running for their lives and no trades happened, but people anticipated all of that, and probably some energy markets spiked in the opposite direction. Fast forward a little, 2008 housing, subprime, financial crisis. We know about that. We'll talk more about that in later slides. I'm not going to put a chart here. But interestingly enough, when things were, now fast forward a couple of years almost, and things were kind of calm or calmer and maybe boring because people were scared of trading, and 2010 was a less hectic moment. Well, we had algorithmic trading creating a flash crash of a few minutes, and this is the chart. Look at the time scale. Noon, 2 p.m. People are now thinking, let me go get a coffee. The market is kind of sleepy usually in the middle of the afternoon in New York City, and people usually go back and trade towards the close. Everybody wants a print. near the close, and something happened, and some trade with the wrong number of zeros kicked in, and all of the algorithmic trading machinery around the world started selling. At the time, I was on the trading floor of the equity trading floor of Goldman Sachs, and it's the first time I remember seeing the head of the equity division come out of his office, which we used to call it the fishbowl, one of those offices with all glass, and he came out, hands on his hips, looking around, asking what the heck is going on. And perhaps he didn't use the word heck. 2018, now we're talking about earlier in the year, there was a vol spike in the beginning of February, the tech crash that happened in October. Let me share a couple of slides. It's probably the font is small, but you can see that it was a significant, from the percentage point of view, significant drop that happened in a couple of days, and later one in early October, when a number of these more tech companies have reported some trouble or were giving guidance on reduced earnings. All of these things are in the big category of market-wide events in a way that affect your portfolio. If you look at how the top 5 companies were in the S&P 500 long ago and how they are now, you can imagine if a sector like the tech sector, the Amazons, the Netflix, and the Googles of the world start having problems, now the entire S&P 500 drops down very quickly. And who knows what's next? Well, there are many things. One that we observed a couple of years ago when the election happened is reactions to elections. Let me rewind the clock a little bit to 2 years ago, and then we'll look at what happened a couple of days ago. This is November the 8th, 2016. Trump and Clinton and Hillary Clinton are neck to neck in Florida, and now all of a sudden people start realizing that things are not going to go the way we're expecting. Everybody was expecting Hillary Clinton to win with a landslide, but it didn't happen, and the market panicked. So in uncertainty, right? This is the typical reaction to uncertainty. And then overnight, I wish I had access to the overnight futures market, because I knew that the market was overreacting, and this is midnight. And then at some point, the market realizes that perhaps other players in the market will see favorably the advent of Donald Trump, who may actually introduce during his tenure regulations and other things to facilitate the financial markets. And the market reversed its course, and now a few hours later, the market bounced back. It happened also with Brexit. I didn't put Brexit on these slides, but the market overreacted and then it bounced back. This stuff happens. It's difficult to time. If you have the perfected of how to time this stuff, I would like to see you after this webinar, and I'll give you my retirement to manage. This is the more recent election market disruption. This is this past Tuesday. The market reacted in a positive way. So if your trades were positioned on the short side, actually you're gonna go lose money. Usually the equity markets gap on the way down and creep up on the way up. But when there are election surprises and things like this, you can see these positive gaps that happen. And this is the S&P 500. Now, in particular, one of the things that was voted and didn't pass was this Resolution 112, which, as many of these folks, all the folks on this call know, regulates how far you can be if you're drilling for oil or for other mineral resources. Let's look in particular one company that is High Pond Resources. Let's take a look at what happened to their stock price the next morning when the market opened. big spike up, and if you were positioning your trades to bet against to bet for resolution 112 and against companies like this, you would wake up in the morning with a very bad and unpleasant surprise. So these are all, exogenous systemic events that affect pretty much everybody, but there are events that affect firms. And then I listed a few here, and in blue on the right, you'll see the response on the right-hand side of the screen. September 1998, long-term capital management failed. There was a $3.6 billion bailout, and the industry created this fall 98 stress test. So in addition to computing Greeks, which is I compute my delta, my vega, all of these nice things that we study in our books, and in addition, after the Black Monday that people created the VAR calculation, we realized that these measures, which are nice and mathematically smooth stress tests to our portfolios, we actually had to create more violent shocks to the portfolios and measure the effect. And I remember when I joined Goldman, there was this fall 98 stress test that was applied to all books every day, just to make sure that if another fall 98 happens, let's pretend that the entire period of fall 98 happens overnight. What's going to happen to our books? Widen credit spreads, drop interest rates, etc. And I see that there is a question from the audience to, if there is time at the end, to go through the VAR calculation towards the end. I'll try to keep one eye on the time and see if we can do that. In 2001, 2-3 months after September 11, Enron fell, and that was the response. There was clearly a failure to supervise, and the industry, the regulators came up with an increased scrutiny in supervision and in actually having people on the hook for asserting that processes and procedures were in place. And I remember having to sign myself, ranging from, the entire firm, Goldman was signing off, people had to sign off, ranging from how we build models, on how we settle trades, everything. And I have to say that once you have a statement, a very simple, short, but powerful statement on the screen that you're signing off with your name, more than once I had to call my team and say, are we sure we're doing this thing the right way? And just this simple activity produce a lot more discipline around processes and the way we do business. March 2008, Bear Stearns. That was an interesting day. I actually have some stories from the trenches. My boss told me to get myself into some random address in Midtown Manhattan, and it was just a beautiful Sunday afternoon in March, but I had to go because when your boss calls, you say, how high should I jump? And I find myself and the other 3-4 guys representing the kind of the quant team of Goldman Sachs, the folks who can use models to attach a price to any derivative or any trade. Me representing commodities and credit, the guy representing FX and currency, one representing equities. We find ourselves in a room. We found top management. Remember, Gary Cohn was there, and they told us, well, we are buying the Bear Stearns derivatives book. They're in trouble, and we are thinking about whether we can, disassemble that bank and take pieces. Can you touch a price to all the derivatives that Bear Stearns has? So we looked at each other, like, well, we need to get all the trades, we need to get all the things in our systems, we can model it. So how long do we have? About a week? Maybe we can pull it in 1 week. They looked at us from above their half-reading glasses, and they told us, you had 2 hours. And when we kindly declined, and we were offered a coffee, and we went home, because clearly this is not something you can do. Well, apart from the joke here, The story there was another company that was, this was like the beginning of the subprime problems, and the company was in big trouble, and somebody had to bail them out, and that happened to be Jamie Dimon, that put a bid for $2. Then he was told that it was 10, but in the process they also got a nice building. Following that, we started stressing financials in particular. I remember that our counterparty trader, our CVA trader, and I spent very long quality time doing stress tests specifically for financials, such as the Bear Stearns, and later on, obviously, Lehman Brothers and other firms, because those are companies with a lot of leverage. And when something happens, it usually happens with a vengeance. Obviously, you fast forward, you have September 2008. People forget sometimes that at the very beginning of September, Freddie Mac and Fannie Mae were basically in trouble, and they went into a special kind of process, which is the government stepped in and they put them in receivership, which means they were technically in default, but the government was guaranteeing all of the existing trades. No more trades, but the existing ones were guaranteed. So what happens is that if you buy a credit default swap on a Freddie Mac and Fannie Mae, the contract is triggered. However, the recovery rate was nearly 100%. And obviously, we had to deal with that. We had a number of credit default swaps. We were loan protection. We had bought protection on Freddie and Fannie. But nobody in their minds would imagine that they would recover 100%. And people lost money because you had positioned your book for assuming that there was a loss, and the credit default swap would recover the rest. And now the credit default swap that you had on this company was worthless because they were basically recovering 100%. Lehman Brothers went down. Obviously, the liquidity test was an important one. And I remember getting this great question from the division head: who is next? And more so, obviously, everybody was thinking, well, let's take a look at Morgan Stanley, and we were doing all of this targeted analysis. But then the powerful question was, what are the top 10 counterparts that I need to worry about? In order to answer that question, you need to figure out this answer for all of the counterparts you have, determine some criteria to sort, hit the sort button, and then see who shows up at the top, which require creating new measures of risk that we didn't think about before. Merrill Lynch, Bank of America, that was a good one. You probably remember that BAML, actually Bank of America, now BAML, Bank of America bought Merrill Lynch. Now imagine the following. Before this happened, Bank of America, great, big company with big balance sheet. A couple of months before the crisis, you think that, Lehman Brothers is having trouble, Merrill Lynch is having trouble. Let me buy a credit default swap that protects me against Merrill Lynch going default. And let me see, who can I buy that from? Oh, let me buy from Bank of America. They produce a very nice quote. Well, guess what? When Bank of America now acquires Merrill Lynch, now the two of them are fused, are one, and now you have a company sold protection on itself to you. That document is not even worth the paper it's printed on. And clearly this was the classic counterparty versus reference entity. You buy protection from whom on whom. And if these two whom are the same person or are the same legal entity, you have a problem. You can imagine that span, created a lot of questions on how many of these problems do we have? How do we resolve it? And now that's a time where traders, the quants, and the lawyers had to sit down together to figure out how to resolve these things. Clearly, me being at the time representing Goldman Sachs, I am not the problem. I bought a contract that was deemed to be legitimate. Now, how am I going to be made whole? AIG, that was another interesting one. Obviously, a company that does write insurance protection for a living in grand scale, and they expanded from writing insurance on things that we knew, like car insurance and homeowner insurance, by writing insurance on financial instruments such as mortgage bonds or credit default swaps or CDOs. And we all forgot one simple thing, is that car accidents that happen throughout the country are uncorrelated. Homeowner insurance are somewhat uncorrelated unless there is a big hurricane. And usually, if you read the fine print of your homeowner insurance, sometimes you're not covered in those cases, or in some of the cases. But when you write insurance on financial instruments that usually pay when the financial markets in the economy are in trouble, during those times, correlations go to 100%, or as we used to joke on the trading floor, to 101%. So AIG had a lot of these trades. We bought protection from AIG. We sold protection to other firms such as pension funds and other real money accounts. And on the trades, on the protection we sold, we had to post collateral, and then we turned around and on a kind of a mirror trade, we're asking collateral from AIG, and AIG disputed because it was a lot of collateral with a lot of zeros. So you had to worry about, is your counterpart going to perform on the collateral because they can't or because they won't? That's another risk that you need to worry about. And there are all sorts of scenario analysis that firms do now on a regular basis. Obviously, the following months, hedge funds fell down, and this was a very interesting analysis that we had to do on the closeout timing. And first of all, you have many. Number two, all of these contracts have interesting provisions. You can have a firm trading with you swaps and repos and other things, and you need to look into your documents and see what actions or failure to perform give you the right to trigger a closeout and serve them with papers. And so that was another very interesting exercise involving traders, the people in the credit area covering these firms, the people in the sales area interacting with these firms, and obviously our lawyers. I'm going to list now on a slightly different topic, different kind of risk. And there are some events, and who knows, maybe people remember some of these things. And let me list one or two. 1994, Orange County, $1.25 billion loss associated with this person. I'm not going to go through the list because I'm looking at the clock is going very quickly. I'm not going to tell you who they are, but just remember these names. Bearing Bank, Nick Leeson. Daiwa Bank, Toshihide Iguchi, $1.1 billion, 1996. Hamanaka, Sumitomo Bank, $2.6 billion. 2002, All First Bank, $700 million. That sounds like a small number compared to the ones above. 2007, SocGen, Jerome Curviel, between $6.7 and $7.2 billion. Just the range itself is probably larger than many losses that other firms have sustained. It depends on how you count. 2006, Amaranth, a nat gas trade went over. 2008, Bernie Madoff, Ponzi scheme, about $1 billion of estimated losses. 2012, after the financial crisis, we thought we had figured everything out, and then the London whale trade happened, and numbers there range a lot. The official-ish number that I found is actually $2 billion, and this is an example of, yet another example of not anticipating risks that actually do exist. And many of these things, if you go through it, will be a risk of an individual performing trades without authorization and without the right controls in place to catch these things. And it happens, and you can imagine after each of those, there was a big fire drill at Goldman from management say, scrub everything. This cannot, I repeat, cannot happen to us. Scrub everything. Make sure that we have all the processes in place. So how do you mitigate risk? There are different ways to mitigate risk, and now I'm going to share some of the secret sauce that we over time developed. And I'm going to start with this page. And some people are probably smiling in the audience. This is actually, when I came here, I started to teach a class and I wanted to present a case, and I had to go back to Goldman and ask permission from the compliance department to present the case, which was at that point a fully completed trade. But obviously, I received this piece of paper that I had to put on the screen. But it wasn't just one. There was a second one, and a third one, and a fourth one. So clearly, you can imagine that this is a possible way. Oh, sorry, there was another one. A possible way to manage your, to mitigate your risk by disclaiming, and we'll look at that. By the way, do you remember that airport in St. Martin? This is how the airport protects themselves. They put a little sign here. This is their equivalent of a disclaimer, and says, careful, this airplane is a little too close to you, stay away. And you could actually die, it says here. There you go. This is a zoomed in version of it. So key principles behind the various techniques that you can use. Do not hide risk. Take your book and market to market. Communicate, transparency, don't hide stuff, don't sweep things under the rug. All of those examples of rogue traders were examples of people, I'm gonna trade, I'm right, the market is wrong, the market will go with me. And guess what? In many of those cases, the market kept going in the wrong direction. And when you are the only person who's right in the room, by definition, you're wrong. Manage funding, liquidity, and counterparty risk together with market risk within the trading floor. Don't assume that risk management is a back office. The first and best risk manager is the trader themselves. And of course, trade-off speed with accuracy. You can't ask people to go and do a dissertation to figure out risk and they come back after 3 weeks with a number. Just give me the back of the envelope estimate, and as I chew on that number, go and start working on refining that. And of course, be paranoid. You will hear me say that more. So you mitigate risk using these principles legally with disclaimers. We saw that. Organizationally, right? You have control functions. For every function that generates risk, you need to have a control function from an independent part of the firm to avoid conflicts of interest. You want to have, for every trader, there is a person in the middle office to confirm the trade, to make sure that the trade is legal, as opposed to a fake trade booked against some kind of a pretend account just to placate your risk manager. But you also need to have controllers. Trader marks the book. Controllers need to make sure that your book is not fake number to produce P&L. Samantha is sharing with me that there's a question from the audience to provide an example, maybe a story from the trench where there was a positive outcome from applying risk managing. Well, actually there was. Goldman Sachs is alive. And probably some of you will smile. The paranoia that we had, and especially we had quite a talented CFO, David Viner. I remember in the beginning of the crisis where we started seeing some elements and we had all these paranoid risk managers. David Viner started accumulating liquidity and putting money into the Bank of New York Mellon and having liquidity just because you never know. And the second action was to reduce risk. And I remember Gary Cohn coming onto the mortgage trading floor and spending 1 hour talking to the head of mortgage trading. The head of mortgage trading had a passionate defense of some trades that they were doing. And Gary Cohn listened carefully for a long time. And then he said, at the end, he said, you're very passionate about this. You clearly know a lot more than I do in the about the nuances of these credit default swaps and mortgage CDOs. But I see that you are too passionate about it. You're not detached enough about the trade. And take off the trade. The market is probably wrong. You're probably right. But when the market will start going back up, you will reconsider the trade. So they started one by one to reduce risk around the firm and go to that famous quote that David Viner had to be closer to home, which was reduce risk. Even if you're losing some money, reduce risk. I can't afford to have too much risk and too much liquidity risk. So that's a positive outcome. Obviously, not a surprise, but Goldman Sachs did well during the financial crisis and limited losses by applying discipline, risk management, and being detached from the trades. Going back to the slides, obviously you want to have math and models. You want to have risk measures and limits. We'll talk about those. Obviously, processes. You want to design and follow processes to mitigate risk. And that goes kind of hand in hand with the organizationally bullet point above it. You need to have an organization that empowers people to push on the brake pedal when there are other people pushing on the accelerator. And also you want to have processes on how to mitigate risk, ranging from how you quote trades, how you book trades, and how you follow the performance of trades over time. And obviously the math and models need to be of different kinds. You want to look at your risk neutral calculations versus risk real. You want to look at history as opposed to what the market is telling you. You want to look at your delta, your vega, all of these fancy names, but also you want to look at your value of risk by some broader calculations on how bad could it get using history as a teacher. And you want to look at scenarios, and you want to invent new ones. Why? Because you're paranoid, and you ask yourself, what else can go wrong? And obviously you need to have the right people. You want to have the right risk managers with trading experience, invest in talent from academia. Sometimes somebody coming from a different angle with a different view may add something that all of us who are attached to the markets and head down day after day, we're missing some of these things. You want to have control functions, market risk, model risk, credit risk, and I'm going a little fast now because we don't have a lot of time. Controllers, corporate treasury, internal audits, right? You want to have people to audit your own processes. You want to have obviously talented lawyers who have the ability to say no. And trust me, lawyers are pretty good at saying no. And obviously you want to have people who monitor operational risk. At Goldman, there was a special team who were just going around and interviewing people and asking how they do things and trying to find holes in the process, in the steps the process is being followed. When you enter trade, you want to verify. You want to always attach a current value to your books. And there will be more in a couple of slides. You want to regularly meet with trader and risk managers to review and openly discuss risk. You don't want to have people go on their own and trade and create risk, and then risk managers have to have to chase them. You want to have a risk oversight committee That includes both risk managers and traders and head of sales, because those people now, are empowered to help you with the definition of the right processes, but also when they go back to their desks and their team has the job to push on the accelerator, they know that there is also a need for sometimes taking the foot off the accelerator and sometimes tapping on the brakes. I talked about market risk. This is important. You know, things happen, political, economic, climatic events, and things reflect on the markets instantly. You don't want to be surprised later. You want to take the pain now, revalue your books under the new market conditions, and take the pain now. That pain that says, oh, my book went down by X dollars, by X $1 million, that pain leads you to action. And taking that pain of seeing the value of your portfolio go down is quite important. You need to ask yourself, how much risk I'm prepared to take? Ask that question before the trade. What am I rooting for? By the way, yes, you need to know. I've seen sometimes young, inexperienced traders do a trade and they thought they were long, but they actually ended up being short. And actually you want to know beforehand what you're rooting for and what situations, what scenarios in the market should trigger for an action to reduce risk. When do I get out? You need a lot of discipline for this one. How long do you want to hang on to that trade because you think you're right and the market is wrong? What risks am I taking on, unknowingly? Yes, paranoia again. You do a trade and everything is good. What risk am I not seeing? So take a step back and look at other things that could actually happen and go wrong. And obviously you need to ask yourself the what if question, which is linked to the previous one, which is, your Greeks are not enough. You need to use scenarios. You need to see what happens if resolution 112 doesn't pass. What's going to happen to what part of my portfolio is going to change because resolution 112 not passing? What's going to happen if Trump gets elected? And not only the medium term, but also in the short term or maybe in the long term. This is an interesting chart that I like to show. This is obviously geopolitical event surprise, the Gulf War. Look at what happened to the price of oil. This is a chart with a lot of numbers, but I remember a salesperson, a trader on the oil trading floor told me that when they came out of that big meeting and I think it was with the United Nations, and the spokesperson came out and said, we sat down to try to resolve the problems, pause, regrettably, and as soon as they said that word, oil price spiked. Weather surprise is another one. This is in cold snap in January 2003. There was low inventory, cold snap, and the March 2003 contract spiked. And we're talking spike, from 6 to 9, we're talking a 50% spike in the matter of a few days. And I know people who were caught short that futures contract, and there is no way to get out of it. And they had to eat a big loss. The question of correlation versus contagion is also another good one. This is during the financial crisis. In blue, you had the S&P 500 dropping, and in green, you had credit spreads obviously spiking. Which one goes first? Which one causes what? Is it a contagion or is it a correlation? Do things happen in the right sequence? This is a longer conversation. I'll be delighted to have coffee with any of you at a later time. I'm looking at the clock that is marching very fast, but we have multiple conversations over the years about who is preceding what, or are they just correlated. Many techniques. I'm gonna go fast. We talked about the Greeks. You want to use the limits. You don't want to use a back book. I remember somebody was mentioning, oh well, trader is taking too much risk. as a risk manager, I'm going to go and trade the opposite position. No, you don't want to have that. You want to have an open conversation. You have limits in multiple dimensions and tight enough that they will be breached. So if you set a speed limit of 200 miles an hour, it's nonsensical. Maybe a speed limit of 3 miles an hour is probably exaggerated. And the limit that you want to have is a limit that we breach, but not all the time, but not never. And something that, and that's my timer that is telling me that I'm out of time, and is a limit that will force a conversation. That's important. You don't want to have a limit just to say, just get out of it. That will force the conversation. That will force the risk manager to sit down with a trader and say, okay, now you're above the limit. Let's have an open conversation. Why do you think you want to hold on to this position? What is it that we're missing? And obviously, you have to ask yourself, how quickly can I get out of this trade? That answer would be different today than it was on the Monday after Lehman defaulted. And again, yes, you use these 9 mathematical measures like value of risk, but you want to have many stress tests, also known as scenario analysis. And I will close on this, and maybe I'll leave it open for a few more questions. By the time I left the trading floor, and now we're talking 6 years ago, we had produced a very large dictionary of stress tests. This market scenario with that currency up versus interest rate down, this versus that. And each of these scenario was shocking prices, and the new price was reapplied, and every single transaction in the firm was repriced from scratch and see the change in value. And this was done for every trade, for every book, for every trader. And obviously, once you had trades, you can always group trades by counterpart. So you can see what these stress tests apply not only to your trading books, but also to your counterparts. How much money can they owe you? By the time I left, we had 100,000 different market scenarios that you would apply on every single trade every night to reprice everything and see how almost impossible or unthinkable market scenario can trigger a loss, and then examine the tall trees of these losses and see how likely those could be. The scenarios didn't have any probability connotation. The scenarios were just there for you to see, what if this market scenario happens? This is what's gonna happen to you, to your traders, to your counterparts. I'm not gonna tell you what the probability is because I don't know, but I will recalculate all of the trades and tell you what's gonna happen. And then that will force the conversations. So the time is over. I hope that this talk has been entertaining and has triggered some thoughts. Always happy to follow up with folks, and I'm going to pass the microphone back to Samantha.
Great. Yes, thank you, Roberto, and thank you so much for all of this information. I know you had me laughing, so well done. But thank you again so much to everyone for joining us for today's presentation. And again, Roberto, thank you so much for sharing your insights and all of your expertise. A quick reminder to everyone before we all take off: to view upcoming webinars and to request previous recordings, please do visit our website at colorado.edu/business/webinars, and have a great rest of your day, and go Buffs.